everyone, and welcome back to this week's Money and Markets Squawk Call, where we go around the horn with our editors to give you their insights on the happenings in global financial markets for this week and beyond. Today is Wednesday. It's June 15th. I'm Mike Burnick, and joining me today are Mike LARSON, Boris SCHLOSSBERG, David DUTKEWYCH, and Mandeep Rai. All right, let's go ahead and get started, gentlemen. So we have a busy week for the remainder of this week, obviously, with the Federal Reserve policy meeting ending today, a two-day meeting. Of course, this is a meeting that will have the requisite press conference from Janet Yellen, along with an update of the infamous Fed dot plot. And I guess all eyes are going to be watching that pretty closely to see whether the Fed's expectations for the future path of interest rates are going to conform more to Fed funds futures, which are showing really only little better than 50% chance of an increase at any time this year, let alone 2 or 3 increases as the Fed has implied previously. In addition to that, we have central bank meetings from the Bank of Japan, the Bank of England, the Swiss National Bank, so an exciting week for central bank junkies like Mike LARSON. Mike, what's your take on all the up and down movements we've seen here in the markets lately? A lot of volatility as we come into the home stretch for Brexit and the Fed meeting.
Yeah, thanks, Mike, and welcome, everybody. You know, Brexit's obviously a huge issue here because nobody really knows how to price this binary outcome. You know, is it leave, does it stay, what's the risk? I mean, you know, the elites and the moneyed interests in Europe and the politicians over there obviously have a vested interest in making it sound like the world's going to come to an end because they don't want anything to shake things up. So, you know, the Cameron crowd and everybody else and the EU people are all saying it'll be an epic disaster and taxes will go up and the stock market will tank and the economy will fall into recession and fire and brimstone will rain down on everyone. You know, and so that's the story they're selling. So on one level, that actually is kind of counterproductive for the markets because if they're saying it's so bad and the polling suggests it's going to be very close, if they vote out, you know, it's kind of a self-fulfilling prophecy. You know, you do have, Reuters had a story yesterday, an exclusive story about all the planning the central bank wizards are doing to try and, you know, subdue market volatility. Basically, they're saying if, you know, they vote to leave, there's going to be conference calls and joint statements. You know, the ECB is going to say, once again, it will do, quote, whatever it takes to save the world, blah, blah, blah. But I think people are kind of seeing that all this central bank hocus pocus is no longer working. You know, the underlying economic data and the figures on inflation. You know, the U.S., Japan, Europe, the Eurozone, the UK, none of these countries are hitting their inflation targets despite trillions and trillions of dollars in QE. Moreover, the sort of migration out on the risk curve that a lot of these central bankers are trying to promote isn't really working anymore, and now people are just flocking to government debt, which is why you just saw a 10-year German yield drop below zero yesterday. A little bit of a bounce from that level in yields today as people kind of, you know, take some positions off ahead to see what Janet Yellen does and what the Bank of Japan does tomorrow. But, you know, I think my main point would be, A, I don't think the Fed's going to do anything. B, I don't really care what they do at this point because the cycle's already turned. You know, I don't know if a lot of you guys have ever heard of Synchrony Financial, ticker symbol SYF. You know, it's one of those companies that works behind the scenes. But if you have a credit card issued by Lowe's or Amazon.com or Dick's Sporting Goods, or if you got a installment loan at H.H. Gregg to buy a TV or Yamaha to buy an ATV, Synchrony Financial is the company behind that actually handles the receivables and the financial side of that. They're the behind-the-scenes company that GE spun off in 2014 that does the consumer financing. Well, yesterday they shocked Wall Street with a warning of rising consumer losses. Basically, customers are having a harder time paying back their loans, and when they do fall behind, the company's having a harder time, quote-unquote, curing those defaults. They're forecasting not a big uptick in credit losses, just 20, 30 basis points versus where they are now. But the fact of the matter is they were recently saying everything was hunky-dory, and the stock was rising along with all the other financials, and the stock just absolutely got murdered yesterday. It was down 13%, which was the worst one-day decline since it went public or was spun off by GE in 2014. If you look at Capital One Financial, Discover, Ally Financial, One Main Financial, American Express, some companies people have heard of, some companies they may not have. All of the stocks got murdered too. I think that points to the biggest risk for the economy and the markets, and that's a turn in the credit cycle. I mean, we've seen wave after wave of evidence that the sort of everything bubble that all this central bank policy inflated between 2009 and mid-2015 is now turning. So you can get short-term periods of calm amidst that. I mean, I basically think the only reason the market rallied off February is that Mario Draghi said he'd buy corporate bonds. That brought bond spreads in, led to some risk appetite, and so on. But the problem is, again, the underlying fundamentals are deteriorating. The market's getting sicker behind the scenes. The financial sector overall, if you chart the XLF, is now in danger of making its third major rollover since last summer and third major lower high. Anything can happen from policy today or tomorrow, but if the chart completes that pattern, it basically shows that even as the S&P kind of got close to an all-time high, many of the underlying sectors, including financials, refiners, airlines, transportation overall, many of these companies didn't get anywhere near their old highs. And I think that speaks to the fact that there's deterioration behind the scenes. So, long story short, all my work on the credit cycle and economic cycle suggests we made a powerful peak/turn in mid-2015. Nothing's really changed since then. So, I've been selling rallies and I've been staying defensive. And frankly, defensive stocks have been phenomenal performers. I mean, anything from telecoms like AT&T to utilities to consumer staples, those stocks have all been making new highs, day in and day out, even as the broad averages have gone nowhere. And behind the averages, select sectors like financials and tech to some degree and transports have dramatically underperformed. So all of that, again, points to an economy that I think is in the pre-recession phase. So I think that's how you got to continue to invest. That's all I got.
Yeah. Okay, thanks, Mike. Indeed, the financials have been very weak, not only here in the U.S., but the European banks have been really clobbered.
Yeah, and I guess I lied when I said that's all I have. The one last thing I'd point out. Thanks for bringing that up. Once I get on a roll, I can't stop. HSBC, Deutsche Bank, Banco Santander, Credit Suisse, UBS. You want to find stocks that are hitting new lows every day. Just go down a running list of all these European banks. And the thing is, these aren't small banks. I mean, this isn't some little podunk companies. I mean, we're talking about hundreds and hundreds of billions of euros in assets that these companies have. And so, you need to watch that. This interest rate, this ridiculous interest rate policy is really crushing the banking sector over there, in addition to sort of spooking the markets overall. So, you can get a bounce anytime. We're getting a little bit of a bounce in the early going on some optimism about what Yellen will say. But the trends certainly don't look good.
Yeah, that's for sure. Definitely in the case of financials globally. Thanks, Mike. I appreciate it.
Thanks.
And in terms of what Mike mentioned about the Brexit, in addition to the central bank volatility we have this week with the Fed and the Bank of Japan and Bank of England and more, we next week have faced this vote about whether Great Britain will leave the European Union. And Boris SCHLOSSBERG, you've talked a lot about that. It's interesting. The polls on whether UK citizens want to leave or stay are running neck and neck. Too close to call, really. But the bookmakers in the City of London that are actually wagering real money on the outcome, they say there's a 60% chance of Britain remaining in the European Union. What do you say?
Well, given a choice, I always go with the bookies. But I will say the bookies have definitely moved their odds ominously and perilously close to break even. They were 72% implied just a week ago. Now they're 60% implied. So, money flow is certainly starting to go to the leave side. Having said this, though, my gut feeling, and I really, this is in no way a prediction. My gut feeling says that UK will remain in the union. They'll still vote for it. But if they don't, it's a very asymmetrical bet. It's a really asymmetrical bet. In other words, if they stay, there is a modest relief rally in cable and cable crosses. If they leave, despite I think the complacency of so many people who think that Brexit is no big deal, I think it's a massive deal for a whole bunch of reasons that have nothing to do with UK per se. Because if Brexit actually becomes a reality, it then becomes a political reality as well as an economic one. Every analysis I've read about Brexit has just made the absolutely horrible myopic error of analyzing this from an economic point of view. Economically, it's not a big deal. UK is still going to trade with Europe. UK has its own currency. There really isn't that much adjustment. will the city of London lose its predominance as the financial center in the world? Probably not, because they still have their own currency, and unless Europe just sort of creates all sorts of barriers, it's going to be very hard to take London out of the equation as the center of the world's capital markets. But that means nothing. The political aspect of it, I think, is the much more important one, which is that if UK leaves the Union, it creates a template for everybody else to go. And there's a tremendous amount of unease and unhappiness in the European Union with the Union itself from all sorts of right-wing parties, whether it be in Austria, which just barely missed having a right-wing president, in France with Marine Le Pen, and in Italy with Giuseppe Breppo, whatever, I forget his name, Breppo. The point being is, I think what happens next is going to be much more important. If Brexit happens, then the threat really becomes existential to the Eurozone. Italy is the most vulnerable of all of them. You know, Mike was talking about banks being under a lot of pressure. I'm sure he'll confirm to me that the Italian banking system is virtually bankrupt. I mean, they're just insolvent at this point. So the woes that are happening in Italy are really severe, and given the political ramifications of Brexit, Italy could go. And as Italy goes, you pretty much forget the European Union. It's not Greece. It's not even Spain in some ways. It's the third largest economy in that zone. If it goes, there is no European Union as far as I'm concerned, because it will pull France and everything else with it. So that's the existential risk, which means that I think the longer-term implications of Brexit actually happening could be much more volatile and create a huge amount of uncertainty in global capital markets, which is why I kind of agree with Mike that it's very important to be cautious on your trades. That having been said, though, I still think status quo probably is going to win out, and it's not going to happen. But if you want to make the bet in the currency market, the poster child, the single biggest pair that's going to express this risk either to the upside or to the downside is going to be pound yen. Obviously, the pound side of it is because of the pound, but also the yen side of it because of the risk. So if you want to take a huge, gamble one way or the other on how the outcome goes, that's going to be the trade in the currency market over the next week and a half.
Okay, we'll keep an eye on that currency pair. Thanks, Boris. I appreciate it. Great insights. Let's see. Let's go to David DUTKEWYCH. David, we've seen some kind of stalling in a little bit of some of the key commodity markets. Gold can't seem to get through the 1290 level, keeps bouncing off that level and retreating a bit. And crude oil can't seem to hold above $50 a barrel. Although both have had really good rallies so far in 2016, do you think it's time for a correction here?
Hey, Mike. Thanks, everyone. Yes, I think you probably are right. Like you said, gold has been in a trading range for most of this year. On the downside, it was about the 1207 to 1200 level. On the upside, it was the 1287 up to about the $1,300 level. And really, gold's been whipsawing in that range, and right now we are sitting right at the top end of that at about 1287 right now. So I would expect the next move, barring any highly dovish talk from the Fed, to see gold push back down to the bottom side of that range. You could see the same thing happen with a bunch of commodities. Oil, as you said, broke out above 50, but it really didn't hold much more than a couple days. Now we're back down to some support at around that $48 level. It's actually broken a little below that right now. We could see it pull back a little further, maybe hit that $46 level. If that kind of gets broken, we could get down to that $43, $42 level. But that would be about all I'd expect to see from crude oil on the downside. But some of the other markets you mentioned, have actually been breaking out as well. We've seen natural gas kind of break out of its downtrend a little bit, trading at about 260 to 261 right now. So that's starting to make a move. There is some resistance a little bit higher around the 1275, 1280 level. The 275 to 280 level. And then also another market that's kind of a little bit more under the radar, but it's actually surprisingly had a good year, as some of the grain markets. We've seen soybeans up 37% this year. Corn's been up about 24% this year. Wheat's lagged those two a little bit. It's only up about 6% year to date. But those markets really have kind of broken their downtrend here. And if we do see a shift in the weather pattern from the El Nino to the La Nina weather pattern and kind of hurt some of the crop production, we could see those markets even continue higher. I would expect a little bit of a pullback before we see them move higher, but those are going to be some interesting markets to watch as we get towards the middle to end of the year here. Equity markets, kind of in a holding pattern right now, waiting for, obviously, the Fed meeting today. They've really struggled to get through to new highs, between that 2116, 2135 level on the S&P. So right now I'd expect maybe the next move, if we don't get through those levels, we're going to get a pullback here. There's a bunch of support around the 2030 to 2025 level on the S&P. If that gets broken, potentially we could see a pullback all the way to maybe 1950. But I think we're going to have to see what happens. Volatility spiked this week ahead of the Fed meeting, so we might see that pull back in a little bit. But if we get a fairly hawkish number, who knows? Who knows where the markets will go here? So I think it's all eyes on the Fed right now.
Yeah, indeed. At least it will be at 2 o'clock today. All right, thanks for that update. Good insights. Mandy Bry, why don't we close out the day with you and give us your take on these turbulent markets we've seen over the last several trading days.
Sure. Hey, good morning, Mike. Good morning, everybody. So it's all eyes on the Fed, just like David said. We're finding ourselves in a similar path. The Fed is kind of looking outside of the U.S., looking at equity markets and all the different geopolitical rumblings, and it's kind of taking itself out of its traditional box, and it's proving itself to be very cautious and moving, interest rates, and the risk is it could be doing that to its own detriment. I mean, we're almost, the average expansion cycle is 7 to 10, maybe even 11 years, and here we are, some 7 years since the recession ended, and we've had a rate increase, and we've got an economic backdrop of low growth, and the rest of the world is struggling with deflation, negative interest rates, and things like Brexit and so forth. But, nearly every instance that we have in the Fed talk, we find this market finds a reason to rally, whether, everything seems to be perceived as good, or if, if the Fed has your back, on the downside, we continue to buy stocks, and continue to buy that risk trade. So as Dave mentioned, we're kind of struggling here at the 21.25, and, now we've seen, as the market has, expanded the multiple, many investors are now moving to cash. Fund manager cash positions are the highest level since 2001, according to some research by Bank of America Merrill Lynch. And what they say is that that's consistent with a recession looming. This market's carrying a pretty lofty valuation. We're at 19.5 times trailing 12 months for a PE, and without the growth, without the growth to kind of justify those kind of valuations, and the sectors that are leading are not the typical sectors you want. You're seeing REITs and telecoms and utilities trying to lead. So that leaves you kind of wondering how much more upside we possibly have here without participation and with those, the slow growth and valuation backdrop. So, as mentioned already, I don't think this Fed is going to raise, but, as always, the language is going to be important. And we'll see what Fed Chair Yellen will say about Brexit. And the last time she said that it was going to, have some significant economic repercussions. And I agree with Boris, and I think it's more of a political thing, and I think it's going to kind of pave the way for other countries, and that's kind of a fire point where, you've had over-indebtedness, you've gone to negative interest rates, and you're trying to propagate, this notion that, central banks can build growth again, but we haven't seen it really happen here in the U.S., and we've led into the recession. We're leading out, but we don't have the kind of growth and inflation that kind of leaves you thinking that everything is okay. We're still on recession watch here. Excuse me. So watch what happens today at 2 o'clock and 2:30. Watch what the reaction is to the banks. They'll be, they've been an on again, off again trade, more times off, as Mike mentioned. But we'll see what they do as the expectations for rate increase modulates. And also watch for which sectors are going to lead after the announcement, the direction of the dollar. So now is the time, I think, to have done your research, have a list of stocks ready, have your ideal price points ready. This market's been in a range for over a year and a half now, and it's bound to be broken. And when it does happen, because it's consolidating, but just kind of trading in a tight range, there's going to be a big move, I expect. And where we have no shortage of catalysts that could make that happen, and we've talked about some of these on the call. I would, some of those are like the maturing economy, the slow growth, the over-indebtedness, lots of leverage, and central banks kind of stepping in some places stepping out, divergences in economic policy. There's just so many reasons why we could get a big move. So I would stay cautious, have your price points ready, and just follow where the money goes.
Okay, makes sense. Definitely caution ahead of this volatility we're likely to see this week and next. Thanks, Mandeep. Appreciate it.
You got it.
Well, that wraps things up for this week's Squawk Call. Great insights, gentlemen. Thank you, one and all. And be sure to tune in again next week. Until then, I'm Mike Burnick for Money and Markets. Good investing.